disclosure of pecuniary interest and general nature thereof? No.
Oh, it's on.
Okay, we have a presentation by Lori Bissonnette, okay, from KPMG with their financials.
Thank you very much, sir. So first, everyone has two little bundles that courtesy of us. So the first one is the statement, and then the second one is that nice color one, which is really just going to summarize everything we say in the first one. So here are the draft consolidated financial statements. So if we go up to the opinion, it would be a clean opinion, ladies and gentlemen, meaning we believe when the audit is done that the financial statements are fairly presented. So if we move on to the statement of financial position. Now, for those of you from the private sector, that's a balance sheet. That's your snapshot at a point in time, namely December 31st of this past year compared with the prior year. Now, your cash position has increased year over year. You're in a very strong cash position. Where did most of that growth come from? It's because this year you acquired about $1 million less, 900 and some thousand and change, less in capital assets than you depreciated. So depreciation is a non-cash item, and you acquired much less than that this year. That was not the case then last year. Your taxes receivable are up a little bit. When we get to the graphs, you'll realize your taxes receivable as a percentage of your tax levy is fairly low on a comparative basis, but it is up year over year. There's a few things in there. There is one commercial client that is up, actually just one single client, $70,000 year over year. And then there are a few that were registered right after year end. And as such, they are sitting in that amount then. Down to grants receivable, because user charges are so comparative year over year. The grants receivable last year had $590,000 for your small communities fund. So that is not sitting in there this year. Then we're fairly comparative all the way down to accounts payable and accrued liabilities. That amount, if you look at last year, you had the holdback for Algoma and Annette sitting in there. So there was a chunk of payables relative to that capital then as a result. Long-term debt is just coming down with your annual payments year over year. Your deferred revenue, the increase this year is your OCIF money, $119,000, which you had not yet earned. You're setting it aside for a specific purpose then. This year, same thing with deferred revenue, your obligatory reserve funds. That's the gas tax funds, folks. And because your intent is to utilize it all this year, 2018, then the amount just got tacked in there then year over year. Employee future benefits, employee post-employment benefits, whichever you prefer to call it, those are the post-employment benefits for individuals as calculated by an actuary. Very little change year over year because the discount rate had a minor adjustment then year over year. Tangible capital assets, that's the number we talked about earlier. Where did your cash come from? You have $929,000 in additions to your tangible capital assets, but your depreciation was $1.856 million. So as a result, it came down. It's not like you got rid of a lot of items, nothing like that. It was, that was the case. Now, what I want to draw your attention to on this page is the subsequent events notes. You normally don't see this, but you are sitting there with 2 subsequent event notes this year, which means that you were very busy council in 2018. And we felt that they were such significant items that it would warrant bringing it to a reader's attention when we release these 2017 statements. So what are those items? Now, might I trouble you? Like, could you flip all the way to note 4? And then we'll go to note 18. I realize that's, okay, so note 4 is your investment in government business enterprise. And there is a line in that down right at the bottom of the note, I believe. There, subsequent to year end. So this is where we have told the readers of your statements that you have accepted a letter of intent from North Bay Hydro Distribution because it's such a significant item, and if it is to come off of your statements completely, then next year it warrants bringing this to someone's attention. Given that it doesn't change any numbers, there's nothing that happened that would change a number this year. However, it is a large item, and we felt it warranted that kind of attention, so it's referenced right from the balance sheet. Then note 18. Perfect. And then this was the other one that subsequent to year end, then council voted to accept a proposal to replace the current policing services with those of the Ontario Provincial Police. So these were two very significant decisions made subsequent to year end, highlighted right on your balance sheet then as a result. Okay, so then maybe we flip back to the income statement. So it's the consolidated statement of operations and accumulated surplus. Now, what I wanted to mention when we look at this entire page, so for those of you with it in front of you, you might look at it and say, they're not really very comparable year over year. You're talking about a surplus last year of $3.5 million and this year of $450,000. What would result in this large difference? Well, ladies and gentlemen, the logic of this is, with capital, when you receive a capital grant, it comes right into your revenue. However, the corresponding expense is depreciated over a period of time with the asset that you have acquired with that grant. So when you think of the monies that you received in 2016, of some more than $3 million more than you received this year in capital grants, but then a net Algoma, those amounts will be depreciated over a period of time, and as a result, it's very hard to compare them then year over year. I don't want you to think that you were, last year you saved an absolute fortune and this year you were, you didn't do as well. That is not the case. You're just sitting there with much, much more than in capital grants last year, and I thought you would be interested in knowing why the comparisons then are so different. So if we go back up to the numbers, your residential is very consistent then. Commercial, industrial, and business, the weighted assessment dropped, as you were aware when you struck your budget, folks, then. It dropped 15%, and you'll see that the actual did come in very close to what you anticipated that it would be. Government of Canada and Province of Ontario, there's where you're going to see, if you compare 17 to 16, this is where you see that huge difference in the capital grants that I talked about a little earlier. So fees, service charges, and donations, those are a little bit different year over year as well, not hugely, but you got a nice $30,000 donation, you got an increase in POA, so just a few little things like that. Licenses and permits, you'll say, gee whiz, what were we budgeting for $414,000 when we only got 112? You expected to have that school permit, and then that got deferred. So that's really where that money was. Under other income, you had last year a gain on disposal of about $90,000. This year your gain was only $20,000, so that's why the drop then year over year. Down to expenses, general government is up from last year. You actually budgeted for it to even go higher. What's in there? This year, the entire reason for the increase actually are maintenance items, which, I mean, there's a question, are they capital, are they maintenance? Ultimately, we all concurred that they were maintenance items, but it was 167,000, so that's what that is. Protection services, you're looking at the third building inspector in there. Transportation, the thing I thought you might be interested in there is what is the difference between the budget and the actual? It's depreciation. You do not budget for the depreciation on that. Health services, land ambulance is down a bit. Social and family services, the DSAT portion. And that's really the bulk of the differences then, ladies and gentlemen, year over year, and variances from budget. That when I reviewed the statements myself and again this morning, even though it's probably 3 or 4 weeks since we left here, those were what jumped off the page at me that I thought you would be interested in hearing about. Now, was there that on the next page? I mean, we could jump to it for a minute, but this is exactly as we discussed. Yes, right there, that there is a big difference in the annual surplus because of those capital grants last year. And there's where you're going to see the massive change in the acquisition of the tangible capital assets. Last year, you had 4.6 million in those. This year, 923,000. But you know what? I'm going to actually tell you what makes up that 923,000 in the other presentation. We've got a list of all the big items, so perhaps we'll save those and run through it then. So can I trouble you then to flip into the other presentation? So this was what I thought were the highlights of the statements themselves, but we will we've got this very fancy looking, although right now we might still have a little bit of ice on some of that water, but otherwise this nice new graph to go on. Let's move up then to, okay. Yeah, so there's the auditor's report, the clean opinion. And this is the one that we request that your team sign, saying we have maintained a system of internal controls, etc., and what council is responsible for. Now, this is where I really kind of wanted to get going, because this tells you all the highlights of what I mentioned to you on the statement, but we've written them down here so that you have those explanations in case it slipped your mind later on. And these are the main 5 things then for the variances on the financial statements. I don't go into quite as much detail as I did when I presented the statement, but the cash with the depreciation, the small communities difference, the holdback last year, the increase in the deferred revenue with unspent grants, and the tangible capital assets. And so what makes up those taxes receivable? Here is the breakdown, folks, from and you're going to see most of it is right there in the current year. And that's those amounts that we talked about a little earlier. Largely it's that one commercial property. The allowance, we looked through the older amounts to see if there was anything where it looked like you might not have the value in the property that would be warranted to, and we might need an allowance. And honestly, while 8,700 is a small number, it looks like it would be totally sufficient for what would be there. Well, here is when I said, let's talk about what's in the tangible capital asset increases. So here are the 4 main items that were in there. There are a few other smaller things, folks, but the connecting link upgrade, the trackless, commercial water meters, then the 178,000, and a plow truck. So those are your additions then. Those are the large additions year over year. Last year, as you'll recall, you had, some in the millions. And this is everything I basically said on the income statement, although I don't believe I wrote down that you don't budget for depreciation under transportation. These are just things that came to mind this morning. And I like that we include these highlights here on the page so that if you ever want to refer back to, and you know what, maybe it's just me who likes to go back and look at things like this, but nonetheless, I thought you might wish to have it as a reference for what had happened, the main things then through the year. This is where, when you look at your budget, you've got the budget then as you approved it yourself. Then amortization, which was not budgeted. Then you've got the adjusted amount, the budget that was shown, and what the variance was. So effectively, that $270,000 that you see there on a budget of $14.9 million is less than 2% off of budget. So you had basically a surplus, less cost by I think it was 1.8, I calculate. Yes, it is, 1.8%. So you were under budget, let's say, on your expenses by 1.8%. And here is where we talk about your financial assets went up by 1.4 million this year, and this is because you had fewer additions than the amortization. We have a note to your financial statements that reflects exactly what is here. The accumulated surplus, a lot of people, when they see accumulated surplus on their balance sheet or their statement of financial position, think they have that much cash available. And I always use the same line. I read a book with this name, and I've used it ever since, called You Can't Eat Your Furniture. Equity and tangible capital assets, that is your equity that effectively you can't eat a road or this building either, but that's the equity in your tangible capital assets, ladies and gentlemen. Your reserves are highlighted in a schedule. That's where most of your increase then went this year. And your government business enterprise is your share of your utility, and that's the 3.7 then, which may be up next year. So the audit was complete. There were no changes to what we had originally planned. We all discussed what the entries would be. The subsequent event notes, those are what I felt was warranted your consideration and review. We discussed online payments at some significance because I had recently been through 2 frauds with brand new entities that we were now going to be performing audits for. And we have set up a structure that, now this is not an issue with you, but I wanted you to be aware of that we had gone through the questionnaires relative to online payments for that. And this last little bit, comparative analysis, and we go through quite a bit to determine, okay, who should we compare to you? What would you find interesting? Are they appropriate comparatives? The first year we did it, I think none of us were too enamored with it, but we came to a good group last year. You are one of only a few municipalities that have both 17 and 16 numbers. All of the rest of the numbers are 16s because the FERS are not yet posted for your comparative municipalities. So we showed yours for 16 so that you can see what you were comparing to last year. Then we show what has happened to you this year so that you can see the trend there. So residential taxation per household. As you can see, there are in this little grouping 5 lower, 2 higher. than you are in that, but you're not way out of line on either one. And the taxes receivable, you'll remember that I said you were up from last year. I think we're at 624 versus 4 and change last year. However, you are still in a very favorable position as a percentage of your total levy. There are a few that are better, but just a few. Debt per household, so if you look at the debt, and you'll see that you dropped it just a very tiny bit. That's your annual payments on your long-term debt. There are, again, 2 who are less. It's funny how it goes. There are some municipalities that you see right on the top end of certain things and right on the bottom of other things. It's when you're comparing them, but I guess it's what their council has chosen to focus on. So you are on the low end on the debt per household. Reserves per household, I would say you're, except for Perry Sound, you're kind of right there in the middle. Where Perry Sound got all that money per household, I'm not sure, but they're sitting there in a very healthy position. Now, by the way, I'll just mention it, although it's you don't need to go back, Cynthia. That the reserves, the ministry does look for when you see a few of them that have very low reserves per household, the ministry gives them some kind of a yellow star at the time to say, please be cognizant of this and try and build your reserves back up. Yours are in that nice middle of the road area where no one would question what you've got. General government cost per household, I was a little concerned that the amount might have gone up too much only with the maintenance items that were a one-time thing then this year, but truthfully, even with those maintenance items, you're still sitting pretty much bang in the middle of the pack. As you have been, you're kind of on the high side with recreation and culture, both costs and recoveries. Cochrane has got, they've got that polar bear thing, and there's a few other little things. And I guess some places, when they are so far from other things, that those costs tend to be a little bit higher, but yours are on the high side for that, and as are your user fee recoveries on this. And those were the ones that we thought you would find interesting. So if you ever think, by the way, gee whiz, I would really have loved to know how we compare to others relative to X, please do feel free to just drop a note to Cynthia or something and she'll get it to me, and then it'll be on your next year's comparative.
Any questions? No. Thank you very much.
You're very welcome.
Thank you. Okay, we have a motion. Be resolved that the consolidated financial statements be accepted as presented. Any questions or comments related to that? All those in favor? Be resolved that the special meeting of council is hereby adjourned. All those in favor? 6:55.